Okay, so the platform is here. First of all, let me show you the difference between trading S&P 500 futures options and the SPX index options. Exactly the same thing, same premium collected, but different initial amount that you have to put down. For example, let's say I'm trading this 66-day cycle in ES E-mini S&P 500 futures. And this is the live trade example as well. I'm not going to put it in because the markets are closed, but I have a trade already open, which I will show you the mechanics of. So markets are down. First of all, you need to look at the charts, the implied volatility of each underlying asset. Okay. Implied vol is quite high. It picked up a little bit again, dropped up, but on average, the implied vol in this product is about 15. Right now it's trading at 25. So it is really high. Another way of checking implied vol on S&P 500 is looking at VIX. What level is VIX at? Here's VIX. VIX is at, this is /VIX. These are the futures of the VIX. This is the VIX, 25. So implied volatility on S&P 500 here is exactly the same as VIX because this thing is built out of S&P 500. So you just need to keep that in mind. This is another technical indicator that I have. We don't really use technical indicators because, again, like I said, we are contrarian traders. We sell into the strength of the market. This is the ATR range in the last 14 days. Only helps us in our 0 DTE trades. But anyway, let's go through the setup. Okay. Now, let's say the markets are down, even though they've picked up quite a bit, but they are still down. Whereas E-mini S&P, 6,787. Okay. Down from its highs, obviously. It's a right click here on the 17 delta. I hope you can see this. This is the 17 delta. Look at open interest and volume. Right now, nothing because the market is closed. If you look at this in the morning, obviously there'll be thousands in there. Look at open interest. We like thousands here. Okay. Not hundreds, thousands, because it's very liquid. It's good. And also one more thing here, you look, these numbers are slightly on the lower side, but if you look into the front month cycle, the one that is currently on right now, which is where we have a position on as well. And if you look at, we have an iron condor, but we started with a short put spread. Look at these numbers, thousands, right? So look, tens of thousands here. This is the most liquid cycle right now because it's 30 days out. The further out you go, slightly less liquidity you get. So that's another thing to keep in mind of. Okay, we will not be able to see the chart properly here. So let's set it up here in this new cycle. 17 delta, right click, sell a vertical. Okay, this is how we set up a bull put spread. 25 points out. The net P&L that you're collecting is 2.75. If I were to trade this, I would take at least 3 points out. This means you are collecting $150. Okay. Now I just want to show you the setup first, and then I'll compare it with an SPX trade, which is also exactly the same thing. So this is our new trade here. 275 is what it's trading at. First thing I do, this is how my platform is set up. You can do it this way or any other way you want. You have to set your break-even points first, okay? That was 516, so you need to set this calendar the same way. And that's your correct P&L chart. Now, this is your correct payoff diagram. Now, look at this number, 81%. That's what we talked about in the presentation. Now, we go for 81%, over 80% probability of profit. What does this mean? What this means is you have an 81% chance of winning in this trade. By winning, what I mean is collecting at least $1 in this trade, okay? Or 1 cent, or whatever the win is. Right now, the way this thing is set up, let's collect $3. It's easy to understand. You're collecting $150 in this trade, and your max loss is $1,100. But look, the amount of money that you will put down to trade this, if you were to send this trade in, you're only putting down $137 to start this trade. Now, remember that futures options are slightly more expensive to trade, meaning you pay $15 altogether to go in and out, compared to a SPY option, which will be $1.30 to go in, $1.30 to come out. This one, you have to do $7 to go in, $7 to come out. So that's $14, okay? They are expensive to trade. You just remember that. But you saw that you are only putting down about 132. But that number is also not correct because I already have a position on. If I did not have a position on, this was the only position in the account, I would have been putting down $300. Like I said, 3 to 5% of our account is $300 to $400. That's what we put to initiate the trade. Now, let me take you through SPX example of the same expiration, same everything, and you'll see exactly what I mean by the difference in futures options versus index options. Futures options are not scary at all. They are the exact same thing. We were in the 38-day cycle. They are all built the same way. SPX, futures options, futures, and SPY, which is the ETF. They're all exactly the same thing. If you want to check the tracking between all of these, there will be none. There will be slightly a little bit more tracking in the futures versus because there's a cost of carry built into it, but everything else will be exactly the same. Okay. So let's say we are setting this up in an index option trade, right? Obviously liquidity is low in index. You see that here. Why? Because futures options and futures are traded by more retail and institutional clients. So therefore, the liquidity is higher in the futures options. I already showed you there were tens of thousands of open interest in that product. Here, not much. But let's just set it up and see. You will get at 17 delta, your numbers will be, your strikes will be slightly different, but we are doing this comparison to check the amount of credit that we need to collect in order to do this trade. So 60 to 70, 60 to 60, I'm collecting 115. That is still not $1.50 that I was collecting on the other side. Let's try a little bit more. Okay, 160 here. Well, we're collecting 160. Now, the exact same product, it's $15 out. When we do zero DTEs in this one, we trade $10 out spreads or 20 max, okay? We don't go 25, 30, we don't do that. We do 20 max or start with 10, 15, whatever the P&L is. But look, if I were to do the same trade here, let's analyze this as well. Okay, let's analyze this. Again, set up our break-even points. 418 there. Again, 82% probability of profit. Perfect. That's what we want. Oh, actually, I did it in the May cycle in the features options, but it's okay. I'm just showing you the amount of money you would have to put down to initiate the trade. Look at this number. $1,300 to start this trade, but you're collecting almost the exact same amount here as well. The commissions here are slightly higher than the ETF. ETF is the exact same thing. You will put down at least $1,000 to start that trade, or maybe $900 or whatever. Okay, $850. So it's a 3-to-1 advantage in your favor if you do futures options. Again, nothing to be scary on the future side. They work exactly the same way. More liquid markets, more everything, and you put down 3 times less money to initiate the trade. On average, we've seen 3 times less money on futures options. Okay. Next one is, so I've shown you the strategy setup. I've shown you the comparison between the two. Now I was going to show you the actual trades that I have on right now. First, let me take you through the oil trade. Okay. Oil is at $88. When we started, we were at probably at 70 when I started the trade a couple of days ago. So here's the trade. I started as a call spread, but as I mentioned in my presentation, when it starts to get closer to our short strike, we convert this into an iron condor when we have more than 30 days left. And we did have more than 30 days left. So when I started, it was 40 days, 43 days. I started on the call side. And then I sold the put side. The put side was carrying a lot more premium. I sold it at 66, 65, always 1 point out spreads because that's what our account can handle. The max profit I have here, potential profit that I can collect is 410. The max loss is 590. Okay, really good credit on the put side that we collected. On the call side, we probably collected maybe $150 on the put side. The rest of it, more than $200 or something. Again, this is the high volatility setup because look at the price action here and look at the vol. As soon as the vol jumped up, I went into the market on the call side. If I were to show you the trades, I can take you to my account statement and show you how I actually started. Let me actually show you one more thing. I'm showing you the Greeks in this trade right now. So price slices, open this up and look at the Greeks. Okay, these are the Greeks that we have. We're almost delta flat. We only have 2 delta open. Gamma is very small because we are further out in time. And you go further out in time, you get a low gamma. Gamma is what we don't like. If you're too close to the expiration cycle, if you're too close to the market, your gamma starts increasing. We are short volatility because we are selling this option. Yes, obviously we are down a little bit because the market is down. We're down $80 on this, but look at the amount of profit we can collect. $400 here, max profit, max loss is 590. And our buying power, don't go with this buying power effect. This is not true. I initiated this trade with like $350 and that's what it is in the bucket right now. So this is the CL trade. The ES trade was the same thing. We sold the put side first. Because the market was down, volatility was up. I sold the put side first. Let's take this one out now. Let's look at it's bang in the middle right now. Even after so much volatility and so much movement, it's right in the middle. Okay. And it's still at 81%, which is a good number. Again, $537 max profit left in this trade, $700 off max loss. If I open up these slices, you can see that we are short vol here, very flat delta because we did not want to take the market risk when it jumped up quite a bit. Sorry, when it went down quite a bit. Theta is we collect $8 of theta each day, negative 34 of vol. So we're waiting for this vol crush. So as soon as this thing comes down more, we will benefit from when it comes down to like 20 level or 21 level, 22 level. So this is our trade thesis. I only have 2 trades on right now. Oh, there it is. Let's try CL. Let's pick out all the CL trades. Okay, so here it is. We did this trade on 3-3, 7 days ago. These are all the canceled ones. This is the filled one. So I filled the call side. You can see this here. I filled the call side at 94.95. at 11 ticks. Each tick is $10. So we collected $110 on the call side. But look at how much I collected on the put side when I sold at the 17 delta mark or the 20 delta mark on the day on 3-5. We sold for 30 ticks. So that's $200 on the put side because the premiums were so juicier. Like I said, IV is the main thing. IV pumps up the juice into these options, and therefore we sell juicier premiums. And back testing all these that have actually showed us that selling into high IV environment. And by the way, this is our blog side. We have a lot of strategies, plus we have back testing strategies. But another thing, we are building the tool that everyone needs. I wish I had this when I was starting. It doesn't have live data yet, but this is the theory behind it. So the tool will actually help you build your portfolio. So you will add your positions, whatever entry price you had, whatever, it will give you the allocation. Then on the analytics tab, it will give you your total return from whenever you started, whatever your base portfolio is. Whatever you put in here becomes your base portfolio. And we then take that portfolio, analyze it against the market. Market is SPY. We are bringing in more benchmarks here so you can compare it with more benchmarks. We are bringing a lot more features like the date control where you can start and end your dates at whatever point you want. The biggest thing here is we are trying to overlay all the option pieces. So how would your portfolio have done if you were to overlay these options on top of your portfolio? Because I think in the market, there's already a lot of backtesting products. You can go research all of them. They do a lot of backtesting. To me, backtesting doesn't make sense because it was historical. How will my portfolio go in the future is what we are trying to build. So based on your base portfolio that you give us, you don't need to enter exact prices. If you don't want to show us, it's fine. Once you build your base portfolio here, then we suggest you to check on how your overlay would go. So what strategy you should overlay on top of your portfolio. Should you just sell calls for premium? At what level should you take off the calls? If you should sell puts, do you have enough cash in the account to control that short put? The whole enchilada. So we will give you all these metrics with your overlay simulations. And this is coming in from live prices. So we have prices in our database for the last 6 years from major indices like SPY so far. Hughes, IWM, and all them are now in process of getting built up. This will show you exactly how much premium you will collect and whatnot. You can select the dates, and then we'll give you the IV regime and the whole enchilada. Basically, we're trying to build this tool to give the users the option to see how their portfolio done in the past and how could it do in the future, or expectedly what will it do in the future. So it's not just going to look at your historical stuff. It's not just going to look at whatever has happened in the past, but this thing will tell you what you can do with your portfolio to collect more income. That's the whole idea. What can you do at this moment going forward? If you have a 60-day plan to collect income, what can you do through this tool? That is just initial stages. Hopefully in the next 3 or 4 months, we will have a lot of features built into this. Anyway, like I said, this will be available for people who sign up for the 5-day challenge initially. From there on, we will expand the database and user base and everything. Again, just to give you a full rundown of what is going to be covered in the challenge. We are doing this 1 hour a day, 3 p.m. Pacific, like today. The price is $149. This will be going up. So we are thinking about increasing because we're seeing a lot of interest. The price will go up next month to double the price because we are providing a lot of value on our organic content, on our tools, services, everything. You will find the contact us here, contact. So just email us. That's the presentation. Now I'm going to unmute everyone. Another thing I forgot to show you, the first 10 signups will get a one-on-one with me for an hour to just look at that portfolio, just to get their questions going. Any doubts they have about option trading, I can discuss that with them. I can show them one of my other strategies I do. Let me bring up the chat again. I've already posted the link there. There's a checkout page. Yeah, do you use stop losses? No, we don't. So we strictly don't use stop losses because we believe that we are active traders, so we manage our risk actively. When I say active, I don't mean we touch the trades too much, but when it comes to managing the trade, we manage it ourselves. We don't let stop losses manage our trades because stop losses are something that it just creates more losses in our portfolio. So yeah, we don't use it. Anyone else on the question side? When do you roll? Okay, great. That's a great question. Like I said, if there are less than 30 days in the cycle, we will roll it out in time. If there are more than 30 days left, so let's say 30 to 35, we started at 45 days out, the spread is about to be breached or touch our short strike, there's 30 to 35 days left. Like I just showed you in my 2 live trades, there were more than 37 days left, so I sold the other side of the spread in that same cycle. But if there were less than 30 days or 25 days left, we would roll the spread out in the next cycle. That's simply how we do it. This has been working for us. We've been successful with doing it this way. Any other question? Always go from IC. Sorry, what does that mean? We start with a spread to fly. Oh, we don't go to the fly. So Fly is too close to the money for us. I don't like that risk. I don't trade like that way. I just don't like iron flies. For anyone else who doesn't know what iron butterflies are, they are basically selling your options at the money, and then you buy the wings on the side. Obviously, when you sell at the money, you collect more credit and you buy the wings on the side. The way we do it, we sell out of the money, we buy out of the money. So we don't convert it into a fly. Once we are in an iron condor, we manage the whole trade either as a whole iron condor, or we manage the trade as a put spread and a call spread separately. If the put spread is in the money, we will take it off, sell another one if needed. If not, we will just wait on the call side, keep rolling the call side, get back into break even or in the money on the call side. That's the whole idea. Thank you very much, everyone, for joining today. It was a great session. We had quite a few people. Like I said, I'm hoping to see you all in the next 5-day challenge. So if there are any questions, just let me know. Thank you very much, Laura. Thank you for joining. I will get my team to send the slides out as well. In the next 30 minutes or something, we will send the slides out. There's a WhatsApp group that we run, by the way. If anyone wants to know, I can send the link here. You guys can join it because it's a lot easier to communicate there. Let me send the link here in this chat. So this is a WhatsApp group. We run this for quick reminders for our 5-day challenge and our masterclasses. You can join this, and then I can send you the Discord group as well. Just be mindful, the paid group on Discord, it's only available for people who pay for the classes, obviously the 5-day challenge. But I'm sending you the invite for the main one, which is the free channel, which we talk on and discuss a few things on. Here's the 5-day plan. We will start with the basics. I will exactly show you how things work in the options market, payoff diagrams and everything. Then we get into the real stuff, which is straight away we put the trades on. Okay, it won't be live because the markets will be closed, but we will set up the trades based on our mechanics, how we do it: cash secured puts, covered calls, credit spreads, and iron condors. Again, our favorite ones here are credit spreads. And finally, the zero DTEs. We trade a lot of zero DTEs in the index option space, and that's what we are going to teach and show you. Now, another big thing, you can read a little bit about me, there's 100% money back. If you don't like it, just email us. You will find the contact us here, contact. So just email us. Thank you, and I will hope to see you next time. Bye-bye, everyone.